financial institutions. We all know that the most important constituent of financial sector is the financial institutions, which act as a conduit for the transfer of resources from net savers to net borrowers. That is, from those who spend less than their earnings to those who spend more than their earnings. In this lesson, we will go through the role of financial institutions, the different types of financial institutions, and the regulatory theory and the role of state intervention. After going through this presentation, you should be able to explain role of financial institutions, identify types of financial institutions, explain regulatory of financial institutions, enumerate state intervention. A financial institution plays a significant role in economic development and in financial stability. Financial institutions perform a plethora of activities through their provision of liquidity, divisibility, informational efficiencies, and risk pooling services, which broaden the spectrum of risks available to investors. They encourage and improve the efficiency of investment and savings in the economy. From the view of financial stability in an economy which the institutions are comparatively less developed, banks will inevitably be required to assume risks that otherwise might be borne by the stock market, collective investment schemes, or insurance companies. The financial institutions play an important role in complementing the facilities offered by the banks in an economy. In fact, the existence of banking financial institutions (BFIs) and non-banking financial institutions (NBFIs) supported by efficient money and capital markets keep the financial sector complete and enhance the overall growth of the economy. Financial institutions can be of different types in accordance with the difference in the financial systems of different economies. First is central bank. Second is commercial banks. Commercial banks are the important part of financial system. They provide the deposits and lending services to its customers. Third is credit rating agencies. A credit rating estimates the credit worthiness of an individual, corporation, or even a country. It is an evaluation made by credit bureau of a borrower's overall credit history. Next is credit reporting and debt collection. Fourth is financial authorities. Regulation of financial institution is very important for a structured growth of a country. Merchant banks. Merchant banking companies registered with the Securities and Exchange Board of India as a merchant banker under Section 12 of the Securities and Exchange Board of India Act 1992. Mutual fund. A mutual fund is a trust that pools the savings of a number of investors who share a common financial goal. Mutual funds are open-ended funds operated by investment companies which raise money from shareholders and invest it in a group of assets. Venture capitalists. Venture capitalists are the institutions that deal in venture capital. Venture capital, also known as VC or venture, is a type of private equity capital typically provided to early-stage, high-potential and growth companies in the interest of generating a return through an eventful realization event such as an IPO or trade sale of a company. Regulation of financial institutions is very important for a structured growth of a country. In India, Reserve Bank of India and Securities and Exchange Board of India are the main regulators of financial institutions. The Reserve Bank of India was established on April 1, 1935 under the Reserve Bank of India Act 1934. The main functions of the bank are to act as the note issuing authority, banker's bank, banker to the government, and to promote the growth of the economy. The RBI performs the four basic functions of management, that is, planning, organizing, directing, and controlling in laying a strong foundation for the functioning of commercial bank. The Reserve Bank of India performs these functions under the guidance of the Board for Financial Supervision. The board was constituted in November 1994 as a committee of the Central Board of Directors of the Reserve Bank of India. In the area of capital market, the Securities and Exchange Board of India was set up in 1992 to protect the interests of investors in securities. The SEBI aims to promote development and regulation of the securities market. The Insurance Regulatory and Development Authority is a national agency of the Government of India, based in Hyderabad. It was formed by an Act of Indian Parliament known as IRDA Act 1999, which was amended in 2002 to incorporate some emerging requirements. State intervention has been pervasive in most developing countries as well as in many developed economies. Financial industry also empowered the government to tame the industrialists by controlling their source of funding. Capital control, interest rate ceilings, credit rationing, and policy lending to priority sectors have been common features of state interventions. One common goal of state intervention was to ensure the stability of the banking system. The state intervention helps in preventing financial crises. Effective crisis containment requires effective triage and accurate diagnosis is necessary to determine appropriate mechanisms for stabilizing the exchange market, resolving distressed banks, determining the amount of support required by banks to be rescued, and estimating the aggregate financing needed to resolve the crisis. Now let us check if we have understood the various concepts discussed in this lesson clearly. IRDA was established in 1992. Right or wrong? Wrong. Venture capital funds, VCFs, are part of the secondary market. Right or wrong? Wrong. The RBI influences the management of commercial banks through its various policies, directions, and regulations. Right or wrong? Right. Before we end, let us briefly revise what we have studied till now. Financial institutions can be defined as private or public organizations that, broadly speaking, act as a channel between savers and borrowers of funds. A commercial bank is a type of financial intermediary that provides checking accounts, saving accounts, and money market accounts, and that accepts time deposits. Commercial banks. Two main types of financial institutions with increasingly blurred dividing line are depository banks and credit unions, and non-depository insurance companies and mutual funds. The two main reasons for the existence of financial institutions are economic development and financial stability. A mutual fund is a trust that pools the savings of a number of investors who share a common financial goal. Accounting is process for recording, measuring, interpreting, and communicating financial data for the purpose of decision making.